were insolvent, i.e. Robinhood. Jason, over to you.
Okay. I think we probably agree on a lot of things here. Thank you for the concise overview. We agree that Wall Street bets and retail investors are incredibly powerful now, and we agree that that's a good thing. We also probably agree that there are shenanigans going on with shorting of stocks, i.e. 120% or 130% short. And we agree, I think, that some of these hedge funds do manipulate the markets with these. We all also agree that it's unfortunate that in order to stay solvent, Robinhood, apparently, if this is the information, we don't have complete information right now. So the thing I do think that you're being tremendously unfair about, and I'll try not to make it personal, Chamath, is that you've been uncouth and you're attacking people with partial information. I'll let you respond to that in a minute. And I think we agree that Robinhood is responsible. Robinhood is responsible for this revolution in retail trading. They created the platform and they created the innovation that got millennials to en masse embrace trading stocks. How did they do it? They figured out a clever innovation of how to make it free and friction-free. They did that because they did this selling of the data and the order flow. Okay, we can debate whether that is fair or not, but Facebook did the same thing. They created a data business. They provided amazing products and services that you yourself built for 5 years and made $1 billion off of in order to make it free for consumers. Now, there are unintended consequences of any company at scale, whether it's Uber, Robinhood, Tesla, et cetera. And they will all have to weather these storms. And I think that there are pieces of information that you do not have, Chamath. And for you to say that they're criminal and for you to say they're scumbags and to act this way is, I think, unprofessional and does you a disservice and does your argument a disservice. And you did this as well with Uber, another one of my investments, and that company weathered the storm and they've done great things in the world. And I'm very proud of that investment.
No.
And I will be very proud of what I believe that
Uber fired
Robinhood
their
will do.
CEO and they brought in Dara who cleaned it up.
Oh, agreed. But they got there. And so I
let's see what happens. So what do you know that I don't know?
Well, I haven't talked to Vlad. I saw what he said.
Who cares about Vlad? He lied on television.
I don't believe he lied.
He lied on CNN. He lied on Fox. Where did he not lie yesterday?
What is the lie?
Well, Jason,
he was confronted about whether there was a liquidity crisis, and he said to their face, "No, that is not true."
I think this is being misinterpreted, and there'll be a clarification that'll occur. I think because they were able to draw down $600 million and because they were able to take down $1 billion investment from the top investors in the world, that they resolved their liquidity problem. Nobody in history has ever created this many retail investors than Robinhood. They are responsible for the movement. When they pitched me the company, they wanted to create this revolution. It is paradoxical that they are now the enemies of the revolution because they actually created and enabled this. And they have been number one in the App Store since this whole fiasco started.
Nothing you're saying convinces me. They are the Lehman Brothers or Bear Stearns of 2008 to me.
And they will not be. They will get through this. And this is an unprecedented black swan event. I think we would all agree. Nobody has
exactly what Lehman and Bear said. That is exactly what they said.
And they will, I believe, Robinhood will ride it out because they throttled the number of people coming to the platform. Las Vegas is not designed for everybody in America to come to Las Vegas in the same weekend. That's what's happened.
Will you admit that the tens of millions of people that had their hard-earned money inside of Robinhood was prevented from participating in trades that could have been executed other places because of an arbitrary decision by Robinhood that they had
It wasn't arbitrary. They had to stay insolvent. How is that
Jason,
an arbitrary decision? Do you think they wanted to make that decision?
Jason, that's me telling you that they were insolvent. That's not them saying it. This is what I'm saying. Right now,
the communication was not perfect, I'll agree. The communication was not perfect. They should have just said, we had no choice but to stop this or we would have been insolvent. We cannot take this many trades.
Is that what we call lies when people's money gets fucked over? Just, it's inconvenient.
Let me just say one thing. I'm going to interject your vigorous debate. The important thing I think to note is Robinhood makes money effectively, as Chamath pointed out, through arbitrage of pricing in the markets and by providing leverage to their clients. So the clients can trade beyond their means. I used to be an investor in a Forex trading company. It was the largest Forex trading platform in the world for retail investors. And 60% of those accounts went bankrupt over time. So there was a lifetime value on an account because the customer would come in, they'd trade foreign exchange rates up and down. They would ultimately just get burnt up, and that was it. Robinhood makes money when the market is non-volatile, when there isn't a lot of swings. Suddenly, when there is a swing, and that's how they're able to provide their free pricing to people, they're making a spread. But suddenly, when there is a swing and the spreads start to widen, they are actually exposed to losing money. So, Jason, it's true what Chamath is saying. Like, they did face a liquidity crisis to some extent. That's why they had to draw down additional equity capital.
Yeah.
But it was a function of their business model, right? Their business model provides great benefit and value in some extent during good times, but when times get bad, it's like, oh shit, things are at risk. And that's very similar to kind of the Lehman and
I don't disagree.
Model.
I don't disagree. I think this is an unprecedented situation with the number of participants. It reminds me of surge pricing with Uber during snowstorms. And that also was an unintended thing that, who knew that it would go up to $400 to take a ride? And that's something that companies will be faced with, and they will have to then adjust and then make it work. And I think, in the case of Robinhood, they should have just came up on Wednesday and said, we can't take any more orders. We can't take any more new customers. We're pausing signups. You'll be on a wait list because we will be insolvent if you guys make any more trades. And that would have, I don't know if you believe that would have.
I agree with that. Okay. So Jason, let me just explain the mechanic.
So then it's poor communication from a rookie
It's
founder.
not. Jason, it's beyond poor communication. People were blocked out of their accounts. Like there was hundreds of incalculable amounts of economic loss.
I don't know if that's going to wind up being true because all these trades are occurring now and the stock is a rocket ship. Who's to say that?
No. Jason.
And aren't the shorts all covered by now? That's what they've been saying on CNBC.
No.
There are still people. How do you know how many people are short right now and how many shares?
Because it's the primes put the data together and they send it to us.
Do you have it handy? Because I've been looking for it online and they said 10 times the number of shares short have traded hands in the last 10 days or 5 days.
Jason, I don't have it literally in front of me, but I could get it in the next hour.
Yeah, just text one of your people. You got all these researchers there. Go ahead, Sacks.
Okay, look, I'm going to try and thread the needle here. I think JCal is right that we shouldn't impugn people's motives without having all the information. And furthermore, building these rapidly scaling startups is really tough, and it could have just been, a function of not knowing how to deal with unprecedented growing pains. So I don't want to be too judgmental.
Can I just stop you there?
Hold on. Yeah.
No, but that's not. No, but David, that's not. But you guys are not being accurate. They have known for years, how this business worked. When somebody buys a call option, they are legally obligated. When they send that order through, they have to post margin on behalf of that person. So they saw this building. This happened in March of 2020. They went through this liquidity crisis. They've had to draw credit lines before. They saw it building in the system. So this was nothing except negligence.
Yeah. So I was about to, I hadn't gotten to the point where I was about to agree with you, Chamath. Look, all I'm saying is even if it was negligence, I'm not sure I would impugn all the motives to them. That's all I'm saying. I'm trying to find some common ground with JCal on that point. But where I totally agree with you, Chamath, is with respect to the effects of their decision. The effects of that decision they made to stop trading, and specifically, they didn't stop people from selling. They only stopped people from buying. So they shut down one side of the trade. And the effect of that was we had these hedge funds from Wall Street. They were on the ropes, right? Let's discuss who these guys are. These are the apex predators of Wall Street. They are in the business of shorting companies to destroy them. That is their business model. And they are not academic traders, who are just speculating on outcome. They engineer the outcome, right? Look at their tactics. Just watch the show Billions, right? They hire PR people. They hire private investigators. They're participating on these message boards, spreading disinformation. Look at the year of hell that Elon went through, right? They tried to destroy
It's like 5
Tesla.
years. Yeah.
Yeah, exactly. They try to destroy companies to engineer that outcome. They create nothing. They are in the business of destruction. Now, the beautiful thing is you had these Reddit kids, these pirates, who published this manifesto, right, on Reddit, basically being the heirs to Occupy Wall Street. They recognize, look, occupying like a physical space does nothing to these guys. We are going to hurt them where it counts in their pocketbook. We are going to get together and we're going to basically create a trade mob that's even bigger than their cartel. And they did. They got 2.7 million people taking the other side of this trade. And then when the hedge funds doubled down, they said, fuck you. We're going to triple down. And the guy on Reddit said, listen, he, paraphrasing John Maynard Keynes, said, we can be retarded longer than you can be solvent. And they were winning. That was what they said, right? And they were winning the trade, okay? And Melvin was dead busted and Citron was on its way to being dead busted. And they had to go to Big Papa Stevie Cohn, okay? And Ken Griffin to get their rebuys, to buy their rebuys to get back into the game, okay? And then they had these guys on the ropes. They had them felted, okay? And then what happens? Just at the moment where they're going to like basically bust them out of the game for good, Robinhood shuts down the buy side of the trade. And so what does that do? It gives these hedge funds time to regroup, to unspool the trade, to reposition, and save themselves, and to get out of the trade if they want to get out of the trade. You can never take that 24-hour time period back, no matter what Robinhood does now. And so I agree with Chamath. This was
don't you think, David, on that point, I think I am in agreement that the hedge funds deserve to get their asses kicked 100%. I also, as I said, we don't have complete information of why, Robinhood had to pause trading and the other platforms. And it was like 5 platforms, by the way, that had to stop or else they would be insolvent, because nothing like this has ever happened before. This is a run that nobody's ever seen. And now we're back in the game. And don't you think all this attention then drives more people to buy GameStop, which is what's happening today? And that they're still going to get crushed because they're still going to have to cover. I mean,
I don't like I said, look, where I agree with you is I think the consequences of this decision by Robinhood they were really bad, right? I mean, we finally had these shorts on the ropes where they deserve to be. Finally, they're getting a taste of their own medicine.
Yes.
And it was really bad to pull the plug on the
and they wish they didn't have to, I'm sure.
Okay, exactly. And I don't know what went into that decision, but here's the thing that I think kind of stinks about it is the point that Chamath is making about who is doing the trade execution for Robinhood. Those trades are flowing to Citadel.
Well, that's part of it.
That's part of it, but 47%. But who is now on the short side of the trade? Citadel went in and bailed out Melvin and Citron. And so they're on both sides of this trade. Now, how does that make sense?
Well, Citadel, but I mean...
What I would like to know specifically, okay, is did anybody from Citadel reach out and touch Robinhood? Did anybody at Citadel put in the fix and saying to Robinhood,
of course, that's a valid question. Valid question.
We're going to cut you off, unless you freeze out the buy side. Now, look, 99% chance that didn't happen. I don't know, but that is a legitimate question. We need to know the answer to that.
Can I just tell you the question is important, but the way that you phrase it is you call them and you basically say, listen, you need to post $500 million of margin. Why? Oh, well, these trades, we're going to arbitrarily change the margin requirements. Okay. Oh, hey, you need to post. So then what they did was they pulled all the credit lines. Okay. They post margin. Trades are still happening like crazy, right? All these people are buying GameStop calls. They have to go because look, when you buy a call, when you as a user, when David Friedberg, Quinoa buys a call, Robinhood becomes synthetically shorted, right? Robinhood doesn't have the share to sell you, but it's giving it to you. So they're technically short. They got to go buy it. Okay. So this is what creates this dynamic where Robinhood knew. They knew every second of every moment what was happening and more importantly, what could happen. At a minimum, it's negligence, and at a maximum, it's the fix.
Well, it was fine to do it before the market started to swing volatile, right? And so when the market wasn't high volume and when it wasn't volatile, it didn't matter because they had appropriate levels of surplus capital or statutory capital or whatever the definition is in this market to be able to cover the quote unquote VAR or the value at risk of their portfolio of their customers' worst case outcome. But as soon as that spiked, as soon as the VAR spiked, they had to go get more capital. And so what do you do if you're the manager of Robinhood in that situation where your clients who've been making you a bunch of money by trading stocks over the last couple of years, suddenly they all get themselves in a bind where the VAR on the portfolio is more than the cash Robinhood has to clear, assuming all these people go bankrupt. That's where Robinhood had to scramble. And so in that circumstance, they drew down debt and they had to go get $1 billion of equity. But if you guys were running that business, and I'm not speaking for Robinhood's, I'm not making the case for Robinhood, but what would you guys have done in that circumstance? Suddenly all your, and by the way, I'm saying they created the problem for themselves because they allowed people to trade on margin with low account balances and volatile stocks prior to this. It got away from them in this week.
You cannot run a business like that and be selective and arbitrary. You can't say some stocks on certain days, some stocks on other days, some options over here, some puts over there. That means you're a fucking moron. And
but what do you do on Tuesday
business
or Wednesday when all of a sudden
it's
exposure...
not Tuesday or Wednesday. If you were a reasonable manager of a business like this conversation would have been happening at a board meeting quarters ago. Hold on a second. Let me finish, please. Okay. It needs to happen quarters ago. And in quarters ago, what they would have said is, hey guys, we've run some scenario analyses. We've done some sensitivity analyses. Here's what happens if all of these things can go against us. That's a typical stress test that a bank has to do, right? When you're a structurally important bank, you have legislation that forces you to be under these conditions where you have to make sure that you can understand some of these scenarios. And then you have to have...
Same with any trading entity or insurance company. They all have to have that analysis of what's the worst case scenario and how do you plan for it.
And you have to... And by the way, coming out of 2008, we actually legislated that we needed to have these 2 and 3 sigma, event scenario planning, and you needed to have proper credit. So here's what happened really. Number one, it was under-equitized. Right. At a minimum, the business was massively under-equitized.
Relative to what they were letting their customers do.
Exactly.
Right? And that's really important because the point is they let people trade with high margin and they let people trade in volatile stocks. And it was working until the volatility.
Not just stocks, but options. Which is what creates the real spin up.
The feedback loop that blows this whole thing up.
And then number 2 is they don't know what they're doing.
I think one thing that's really important, I just want to say this. We should stop pretending that trading in stocks is investing in businesses. And this is something we've said for a long time on Wall Street, but stocks, shorting, margin, and derivatives, those 4 things no longer look like what the capital markets were originally set up for, which was to help capitalize businesses and allow people to exit their investment and helping to capitalize that business to another investor that wants to come along. It has effectively become a synthetic casino or a synthetic gambling model that lets people trade things up and down. And this has been the mainstay of Wall Street for the last couple of decades. And as you pointed out, Sacks, it really is a leech on the system because the amount of money that trading firms and traders and hedge funds make doing this ultimately is taking away from capital that could be invested in actual businesses that could drive job growth, drive economic prosperity, drive innovation. And the volatility that I think we've seen is the ultimate feedback loop that emerges from when you allow a casino to operate that sits under the guise of being business capital and investing in businesses. It's not. I'll give you guys a statistic. I downloaded the data from CBOE that analyzes how much volume was traded across all the equity markets last year in the US. Stocks traded a total volume last year. You guys ready for this? $121 trillion of notional across 2.7 trillion trades. Do you think that $121 trillion of notional equity value trading provided capital to businesses anywhere close to 1% of that total amount of trading volume? It really is a synthetic instrument that allows people to participate in, I bet that something is going to go up and I bet that something is going to go down with other people of a similar ilk. And one person makes money and one person loses money. And at the end of the day, the underlying business entity doesn't benefit whatsoever. And you see it when shorts go against businesses like happened with Elon and Tesla. And you see it when derivatives like CDOs blow up the fucking housing market, where people basically trade these derivatives that sit on top of housing, and that capital did not find its way into homes to help people buy homes. It ultimately led to the collapse of the
only reason that Lehman and Bear Stearns was shut down was in 2007 and 8 when they were in a liquidity crunch and the same thing, and they basically had all these trades blowing up against them, and they couldn't collateralize them. Was that the people on the other side were hedge funds. And that's why, they were put into the Fed. And that's why we were able to basically come out relatively unscathed. And what I mean by relatively unscathed is like a global calamity. The tragedy of this is that this is the tragedy of the commons. It's like, there is no organization of people that can say, hey, listen, I'm really rich and wealthy, and what happened here was wrong, even though it's probably on the same scale. And so everybody that was a participant in it is, in my opinion, I think is guilty of all of this. They were complicit in the robbing of America.
Do you think calls and puts and shorting should be allowed? Should those markets exist?
I do have a sense of common sense solutions, and let me kind of give you them, and then you can tell me what you think. So the first is we need to use modern technology. Let's just start with that, right? To ensure that, one share of stock, right, isn't loaned out multiple times, so that you can't have a scenario where you have more than 100% short.
That's a no-brainer, right?
That's a no-brainer.
So you still support shorting, Chamath?
Yeah, let me just go through the list, and then you can tell me what you think. If high-frequency firms can trade tens of millions of shares per day, there's no reason why we can't reconcile who the beneficial owner of every share is. So maybe that's now maybe we found the first obvious use case for a blockchain, right? Like you can't borrow a share unless you can prove beneficial ownership in a nanosecond, which can only be done on a decentralized ledger. But the point is, number one is we need to rebuild this infrastructure. You can't have 136% of a company be short. That makes no sense. The second, what we've learned is that, again, it's like, are we going to basically have these blowups every 10 years before we actually address the elephant in the room, which is leverage? Like, you need to have leverage limits. So, for example, banks coming out of 2008 have super strict oversight and leverage limits because they're dubbed systematically important. We don't do that for hedge funds, and I think we need to. And I think that we need to have the ability to realize that these guys can cause systemic risk, right? So, just on this example, I don't know if you guys have ever heard about long-term capital management, LTCM. This guy, John Merriweather.
The Asian currency crisis, the whole thing collapsed. There's a good book on it.
Well, so it's funny, but if you guys think this is the second financial calamity, it's not. It's the third, because the first one happened in 1998. So in 1998, there was a firm called...
The whole economic system was going to collapse if the bailout didn't happen.
So listen to what these guys did. Long-term capital management borrowed. They had $4.8 billion of capital that limited partners and investors gave them, okay? These fucking crooks were able to then borrow $125 billion. $125 billion on the $4.8 billion of notional. So they were able to lever themselves up 26 times.
By the way, synthetic margin, right? No actual capital was allocated to these to this transaction set. It was all synthetic. Like no money moved accounts when
no money moved
happened.
Accounts.
So it was literally just writing stuff against debt that couldn't have existed.
Yeah. So they built 60,000 trading positions, and those individual positions represented again $1.4 trillion US dollars. Right. So you took these guys in a room, took 4.8 billion, got knucklehead over here to give them 125, and then got these knuckleheads to sell them positions. And all of a sudden, 4.8 billion equaled 1.4 trillion. And so then US regulators had to step in. They had to orchestrate a bailout from a consortium of banks because they were concerned that if LTCM collapsed, the whole system would collapse because they didn't understand. So we have to put leverage limits on top of hedge funds. The third is we need to improve disclosure. The rules at the SEC right now is to discourage disclosure. That doesn't make any sense. We should force everybody to publish what they own on a weekly or monthly basis. You have the ability to do it. The technology is simple. So you need to improve disclosure, because then watchdogs and other people can basically be looking at it all day and identifying these risks faster, not slower. The third is we need to do something around open trading. Like, why is it that people are allowed to go to casinos? Why can you, buy lottery tickets? But all of a sudden, like, we're going to decide who's financially literate. A platform like Robinhood can decide what's bought and what's sold. I don't think that's fair. And then the last thing is I think that we should have a short-term trading tax. We tried to pass one in 2018, 10 basis points. If you had passed this 10 basis point tax in 2018 on short-term trading, it would have created $1 trillion almost.
I did the math on this because I actually, the reason I ran all the equity numbers was to figure this number out. So in the US, we generated $160 billion in capital gains tax last year. And if you look at the volume I described earlier in terms of notional traded of equities and number of shares traded, if you charged 0.1% every time someone sold a share on the value of the share they sold, it would equal the capital gains tax. So what you could do is you could charge 0.1% on every trade. It would reduce all of this high frequency nonsense where people trade in and out of stocks. It would force people to trade for the longer term or basically invest in companies. And you could get rid of the capital gains tax. Think about that. If we didn't have to pay capital gains tax and we were only taxed when we traded out of a stock 0.1%, you could see an incredible amount of capital making its way into businesses. And this would fuel economic growth and jobs and prosperity. And so I think if you could pull that off, put the two together, a 0.1% sales tax on every share sold and get rid of capital gains tax, it could be incredibly powerful.
The lobbyists got to that bill, but that 10 basis point tax on high frequency trading, it just means like, look, if you're going to trade a whole bunch of shit every 8 seconds, you just have to pay 10 basis points in and out. $777 billion of incremental revenue to the federal government. And it was lobbied out. And I agree with you. And by the way,
more money goes in, more money makes its way into companies, right? And that's you stop all the nonsense where people are basically trading to bet that something will go up in the short term, and you get people to make investments in the business as opposed to the momentum.
Lowering the capital gains rate is genius, because I think that if you are a retail investor and you can, for every year you hold, if you can decrease your cap gains rate by 20%, by the 5th year, now all of a sudden retail folks aren't necessarily gambling, they're owning, and their cap gains rate would be 0 after 5 years. That would be amazing.
I have a basic question. I'm interested in your position, Sacks, and maybe even around the horn. What happens to if the short positions get covered, which they're going to be at some point in GameStop, I would think, or some large amount of it, when the short squeeze is off, what happens to the people who are buying in, to the meme stock as a retail investor, let's say over the next 10 days? Are they going to be left holding the bags? Is there any way this company could be worth 20 billion or 25 billion? Because as Friedberg points out, people are not buying GameStop. They're trying to destroy a hedge fund who made a stupid manipulative bet. Great. We all love the Robinhood story of that. Not Robinhood TM, but the generic term Robinhood. What happens to those people? Are they going to be the last people holding the bag?
Probably. This is not going to end well. There's no question about that. I totally agree with you that people engaging in this kind of speculation and buying at these prices, it's not going to end well. Now, I do think that the Redditors actually had a brilliant strategy, right? When they noticed that these hedge funds were overshort, overexposed, and they seized on that vulnerability, they did to the hedge funds what the hedge funds usually do to everybody else, which is find the Achilles heel, right? And pile in. So I think the strategy started brilliant. Now, anyone who's piling into it, I'd be real careful, because I think the hedge funds have regrouped, and, the idea that you're going to beat them at their own game, Citadel is executing your trades. Right? That the order flow is going from Robinhood to Citadel. They're not going to be caught flat-footed. They're on the other side of this trade. And so, I just think the house always wins. I'd be real careful about getting into it at this point.
I think
just so you guys know, Robinhood just tweeted that now the list of restricted names is now up to almost 35 or 40.
I think it's worth.
They're randomly picking companies, guys. RLX. What is RLX? I think that's Ralph Lauren. Nope, you're not allowed to trade that. SNDL. I don't know what that is, but you can only buy 10 shares.
Would a better solution, Chamath, be for them if they can't handle this and they have the risk of ruin to just say, we're not adding any more accounts until we can digest all this and raise enough capital to float all this? And do you think there's a chance the SEC is telling them, you got to pump the brakes on this because we can't have a market crash? 2 questions, Chamath.
I think that the issue isn't Robinhood ability to grow. It's that they don't have their ability to run their business. And so their incompetence is going to cause them to, I think, have to deal with
if they had $20 billion in cash right now, this would not be an issue, right?
I think you're right.
Okay, so assuming they can line that up, because that's probably what's going on right now, is a $10 billion investment is going to go into this company pre-IPO so that they can actually take advantage of this situation and grow. So despite the fact that you have an axe to grind with them because you have SoFi, a competitor that's very far behind them, that had its own colossal problems, let's put that aside for a second. You're talking your own book without even mentioning it. Do you think that if they had that 10 billion, they would just open up all the doors, or do you think maybe they should say, hey, we're not going to add anybody else?
I think that what's going to happen is they're going to get sued into oblivion. I think that the class action lawsuits here, when people talk about the implied losses that they had over the last 24 hours, David Sacks is right. You can't undo it. The thing is, like in all of these other situations, like in the Uber fiasco, you can't claim much damage. Right? Because you can't measure it. You could have taken a bus. You could have taken a taxi. You could have taken a lift. Maybe you could have walked. Who knows what it is? But the point is that the economic impacts, I think, were much less than maybe the psychological impact, right? Like you were angry. Here, it's the exact opposite, which is that you prevented people from transacting in an open market. And when people signed up to use the service, that's what they thought they were signing up for. And they thought that the risk on the back end would be managed. You have to remember, it's not that the individuals did anything wrong by buying or selling. It's that Robinhood did something wrong by not being able to manage their business accurately. And then that impacted the users to the tune of tens of billions of dollars. That has to get adjudicated. And so, yeah, I think the right thing to do is to stop the business, hit the pause button, allow people to elegantly transfer their money out. We have to remember, on the back end of this, whenever that you have one of these market failures, the clearinghouses are allowed to instantaneously close your account and transfer it to another broker. Instantaneously, you have that right. And so the market does understand this systemic risk at some level. They just didn't push it all the way through to the end of retail. And so we're going to have to unwind this and unscramble this egg because it's a really big problem.
Yeah. You didn't mention
growing willy-nilly, because everybody's infatuated with valuations and blah, blah, blah. And you move into a regulated market where you needed to understand capital constraints, you needed to understand modeling, you needed to understand 3 and 4 sigma events. It just means you're underprepared, which means at a minimum, you can't be doing business until you get that shit under control.
Yeah, I actually think we're almost in sync on this. You have a little bit of an axe to grind because of your other portfolio company, I think, that you still won't recognize that you have
let's talk about
a horse in the race. Because SoFi, did they finish resolving all of their harassment lawsuits? Is that all resolved now, or is that still open?
Yeah, we
and then you took them public. So did you work all that out before you took them public?
Yeah, Jason, we transitioned the CEO. We completely hired a new team.
Great.
I mean, it's incredible.
Great. So your company that you took public can resolve issues, and you can give them time, and then you can in fact become their mentor, and you can become their savior to get them public and save that company.
Jason, you should.
But Robinhood can't. Robinhood can't.
Chamath can't talk about his company that's going public right now. So just as his lawyer, I'm going to step in and
no problem. I just want to point out,
make sure you don't goad him into saying something he shouldn't say. Yeah.
All of our companies, and I don't mean to create a lot of collateral damage here, but Sacks had a company that had challenges. Chamath had companies that had challenges. We all had companies that had challenges. And I think focusing on what is the role of an investor when your company faces challenges, I think the role of the investor should be, and I take umbrage to you, Chamath, trying to dunk on me because I'm supporting an investment. I think it's a low blow, and I take it personally. I'll be totally honest. I am trying to work with the company to help them resolve the issues, and I need to be loyal to my founders. And I need to say, hey, how do we resolve this? How did we get here? And work with them. And I'm sorry that I'm ride or die, but that's how I approach this, is I should be trying to be helpful as a shareholder, which I think you try to be too.
But could you make the argument that someone dunking on your company is the equivalent of a hedge fund shorting a company?
I'm talking about my personal relationship with Chamath, which, it's different than, the public markets, right?
No, but what I'm saying is, like, I think in the private markets, we hear a lot about venture investors, often speaking good about their own companies. Where people really get irritated is when venture investors speak bad about other companies. It's the equivalent of the hedge fund short. And,
it is dunking.
Chamath may be dunking on Robinhood. I don't hear him dunking on you. I mean, not really.
He just said I stumbled into the investment at the opening.
Well, you stumbled into Vlad in a bar. I mean,
Jason. You told the story.
Recognized me in a bar and came up and pitched me a startup.
Jason, but you told the story flippantly on television that you ran into Antonio's nut house. What do you want us to think? You didn't tell us, hey, listen, I had systematic scouts reach out based on traffic growth. I sat down.
That's not how I get deal flow.
Fine.
I get deal flow by doing a podcast.
So Jason,
then Jake, if you want me to apologize for saying
your deal flow is through this podcast.
But Jason, if you want me to apologize for saying that you stumbled into it based on your public description on television, then I'm sorry. But it doesn't take away from what we have. I think the investors' responsibility. This is what I think is fundamentally wrong with Silicon Valley. We are people that basically do this like hero worship around founders, and it's stupid. I think we have a job as fiduciaries to the users and to the employees and to everybody else that doesn't have a voice. And most investors are incapable of actually pushing people to do the right thing. Okay,
I'm pushing to do the right thing, and I've
learned the hard way. And in this example, what I'm saying is this problem should have been solved 3 and 4 quarters ago. And that's a governance failure.
I mean, look, so Chamath, you're right about that. But I mean, just to give JCal a little support here, I mean, the reality is, we've all been on the inside of these hyper-growth companies, and, like mistakes happen all the time because you're moving so fast. And yes, it should have been fixed, but stuff happens. Now, the question is, when bad stuff happens, is it an integrity issue, or is it negligence, or is it just people running too fast? And I don't think we know that this was an integrity problem. I mean, it could have just been people running too fast.
But David,
that's what I think.
You knew what the rules were, meaning I think it is an integrity issue. The rules were not like all of a sudden in a crystal ball and there's a magic 8 ball that spits out a rule. When you do a deal with DTCC, when you did a deal with your holding company for clearing, you signed contracts. Those contracts should have been modelable. This is an Excel problem. This is not
I hear what you're saying, and I'm saying I don't completely know. I want to get to the bottom of the relationship between Citadel and Robinhood, and I want to understand if there was any undue influence there, okay? Or whether this was just a case of hyper-growth catching a company by surprise. I'm not defending them. I'm just saying I don't know, and therefore I think it's a little bit premature to be talking about giving this company the death penalty.
And I also don't think, is there even a possibility that this has ever happened in the history of the stock market or the modern stock market? That 10 million hold on, I didn't even say what it is. 10 million new retail investors came into a stock, or millions of them a day, and that the stock traded 10 times. I don't think that we've ever had social media collide with finance like this. And it's very reminiscent of our discussions with democracy and journalism, censorship,
by the way,
and politics. We're having weird behaviors because of virality. And I think seems to be the common